So anyway, welcome guys. We'll get started. I'm sure more will just wander in. Here they come. Okay. So good to have you here. I wanted to do this call just I don't know. Just thought it would be fun because I was writing this book and I was realizing you know how you learn something or you just do something, you just know something and it's just you know it and then something and then you realize, you know what? I learned this back then and it's been very helpful for me. I'm sure you all have things like that, your business or whatever, or you learned in your personal life. And it's like, how'd you learn that lesson? So I was writing this book about my time on Wall Street. It's an investing book about how to avoid bad investments and spot good ones, kind of everything I do with the community. And so I realized while I was going through it that I learned all these things, and I thought it was really interesting. So I'm going to share it with you. I never shared it in this format, and we'll get into that in a second. And I'm going to share with you. I'm going to watch the chat here too. So anyway, let me just get this. I run my own tech, so it's like anyway. All right, here we go. So Wanda, you let people in, and I'll just do this. I'll just do this thing. I call this the 5 secret truths I learned working on Wall Street and how they're crucial investing smartly for my entire career and in 2026. And so I'm just going to tell you who I am a little bit. Most of you know me, I think, but maybe not. I'll tell you in a second. I'll just tell you what my mission is really, really quickly. I'll tell you these 5 secrets, and I'll tell you how to learn more if there's something you want to master in the investing, and we'll do a Q&A at the end. Some of you asked questions. Actually, Wanda, could you download? They asked questions when they registered, and I realized I didn't download that. It should be in there and just format it, please. We'll get to that at the end. So no one taught me these 5 secrets. I learned these things from observations. I was watching how things worked when I worked on the trading desk in Wall Street. I was in my 20s. It was 1996 roughly when I went in there. It was 1996. And I joined this Credit Suisse First Boston. And I will tell you about this in a second. They were observations, and they were so crucial to me over the years, these few observations that I made. And everything we do, there's 2 clear benefits. The main thing that I started was I wanted people to avoid getting into bad investments. There was some bad investments that I'd seen people get into and lose money, and like how to tell the difference between that, how to tell what is good, what's bad. This is not always simple for people to do. And then really the truly great opportunities, a lot of them are not hyped. I gave stocks to my master's group this year, such as Bayer in Europe, which no one was paying attention to, which is up 80%. Dollar General was up 70, I think 70 something percent since January 2nd. I gave that thesis to the group. Estee Lauder. These are all companies that were not the hot companies of the day, but they're up quite a lot. So that's basically what I spend my time doing. If I wasn't talking to people, I'd be doing it anyway, because that's what I love doing. I love looking for great investments. My mission is basically to banish the misunderstandings and falsehood and hopefully get you not to have delusions about what things that are in the investment world, what's good and what's bad and what works and what doesn't. And investing is really just, before I get into this, just lay like a couple slides of groundwork. But it's basically, investing well is like a weird combination of patience and aggressiveness. There's not always things to do. So you have to be patient. And then once in a while, there's something really good to do. And when you see that, you have to take advantage of it. The real skill is how to make the judgment between what's good and what's not, or what's just mediocre. That's the skill. That's the art of it. I always call it a science and an art. The science is you can look at some numbers. You can see things about how much company's making. The art is making that judgment about the future of the business. Is it really a great, sustainable business? And just a couple of things just to lay the groundwork of how I think. First of all, you don't need a financial analyst degree. You don't need these things to be a decent investor. This is Monish Pabrai, who became a billionaire investing. He said, and now he runs a hedge fund. He said, "I'm not a person who's formally trained in investments. I didn't get an MBA. I didn't go to business school. Basically, I learned from studying Warren Buffett and Charlie Munger, and I studied them carefully. And that's what we do in the Masters Group. That's what I do." Just my brief history. Again, my name is David Leiter, for those who may not know me. I think all of you do. From the Tony community. I love Tony. By the way, you all should go to Tony's Platinum Financial event, which is coming up in February if you're in that group. That's always an outstanding event. Tony gets some of the greatest investors in the world to show up. And only Tony can pull those people, get them all in one room over a course of a few days. But I worked at Credit Suisse First Boston back in the 90s. And this is where I learned these lessons primarily. Then I went to a proprietary trading firm, basically Schoenfeld, which became a hedge fund. And that was basically to trade the firm's money, try to make short-term profits, though. It wasn't something that really resonated with me after doing it for a few years. On the side, I was buying real estate since 1998 in New York City. I still own the properties there today, and I own a few other areas, but primarily that's it. And I manage my own money. I'm a private investor. I'm not raising money. I don't have a hedge fund.
Hello,
I'm not a
Miriam.
financial advisor. If
Hello,
you
my
could,
love.
if you could mute yourselves, please.
No.
David, you're muted now.
Oh, okay. Can you hear me? Okay. So I sold my management company. I had a property management company in New York. I was just managing, I did it for my own buildings, and then we started managing other buildings for other people. And I sold that in 2020. And I was basically sort of semi-retired. I didn't really feel, I was happy not to do anything. Let's just say that. But I also just got back into really spending time looking at investments. And I just started writing stuff in 2022 when it was now become, I call the ultimate investor. Not me, I'm not saying I'm the ultimate investor. It's sort of just a brand name where it's, that's what we teach, how to do fundamental investing, which is what works the best over long periods of time. It's trying to understand businesses and buy them at fair prices, great businesses at a fair price. 2023, I spoke at Tony Robbins' Platinum Finance event, the one I just mentioned. Shared the stage with Ray Dalio, Jeffrey Gunlock, Jamie Dimon, and others. It was a great honor to speak for Tony. I'm always grateful to Tony. He put me on stage. He read my stuff, and he believed in what I was saying, I suppose, and put me on there to talk to the group. And I speak at the Wealth Mastery events I have for the last few years. This is a picture of me on Platinum Finance. It was me when Tony came on at the end to do Q&A. That's me in the virtual studio, waving to a camera because there was no one there. That's me at my house, the batting cage. How many came to the batting cage? I used to have this batting cage at my house. It was a huge building on my lot, and I invited everybody for an event. So we had fun. There's some people. Anyway, I have a book coming out in June 2026. By the way, the WhatsApp, we have a WhatsApp group. I think probably all of you are in there, but you can go in there, that group, and you could post, I think maybe Wanda had posted that in the chat. And also I have social stuff you can check out. Because I'm going to do a lot more stuff on social. And I think Wanda will post those links on Instagram and X and things like that. But anyway, now before we dive into lessons, I just want you to understand one thing. There's two markets going on at all times. And it's important you understand this because this is also a secret, I suppose. I didn't learn this back then. It took me more years to learn this. But there's the casino and the cathedral. This is how Warren Buffett phrased it. The casino is going on at all times. People are betting on price movements. That's why you see stocks going up and down and up and down. And people are all the time making decisions for various reasons. Some are hedge funds, some are individual investors. And then when markets go up, it attracts people and they go in. And then when markets fall, People get scared, they sell. So you have this going on all the time, but it has nothing to do with the underlying businesses. It might have nothing to do with the underlying businesses that stock represents. A stock is an ownership piece in a business. So you can stay out of a lot of trouble just understanding that and actually take advantage of markets. When you buy businesses, and this is what Buffett said, he started when he was 12. So he said, or 11 he started. He got an early start. Warren got an early start. He said, for 8 years, I thought the important thing was to predict what a stock would do. He tried to play the stock market, you know. That's what most people do, 95% of the people. He was trying to predict it. And then he read Ben Graham. There was a book called The Intelligent Investor. When he was 19 years old, he realized, and he said, I realized that I wasn't doing it exactly the wrong way, but it didn't hurt that I had the background and everything. I rejiggered my mind and I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded. Frankly, folks, if you get that point, I think my job is done, but we'll go farther. But really, that's really the stock market. If you think of the stock market as a piece of a business, you'll do much better over time if you enjoy that process of looking at it. If you don't, you probably should just own a stock index, which you'll own a piece of all American businesses. And then the only decision you have to make is, do you believe in America? Do you believe America will grow in the future despite the problems? And that's the only bet you're making. Okay. I know I'll win over time. That doesn't mean I'll beat everyone else, but I'm in a game. It's very, very easy if you have the right lessons in your mind about what you're buying. I'm not buying stocks. I'm buying pieces of overwhelmingly American businesses. Okay, so for me, I'm just trying to do this, what Howard Marks said. My results, I want always good, sometimes great, never terrible. I don't want to get crashed out in the market and have problems in that regard. So I'm always trying to get good results. This is my results year to date, actually. This is from like a day or two ago. I'm up 17.6%. The S&P 500 is up 14. That's just this year to date. You can see year to date. But not only that, if you look at this chart here that's highlighted yellow on the left, when the markets fell 20% in April, I only fell 10. Now, to me, I like that. I don't like to lose a lot. I don't want to sit through big drawdowns. The reason I only fell 10 is because I have stocks, value stocks. I'm not in Nvidia. I'm not in Palantir. I'm not in gold. I did own gold for a short time this year, but I just buy businesses and it works. So I've shown my results every year to the group. Oh, sorry. Anyway, now we'll go real quick. I'll tell you a little story about these lessons. So when I was on Wall Street, the first secret I learned, I was working on a trading desk. You know, you've seen the old movies, the trading desks? You have like long desks and they got a turret, phone turrets. And back then, you know, you pick up the phone, you walk to they had fax machines. It was like ancient times. Anyway, we'd all be on this desk together and it was a lot of action, but we weren't trading equities. We were selling bank loans. Basically, the bank, Credit Suisse, would say, we'll loan hundreds of millions of dollars to a company. And they were companies that were not investment grade. This is where the first lesson comes in. They used to be called junk bonds. How many heard the word junk bonds? Right, so junk bonds meant that they weren't the best quality companies. And a guy named Michael Milken made those famous in the late 70s and 80s. And that's actually where Howard Marks worked with him at one point. And what happened was that we were selling bank loans, and they were called high yield at that time. They changed the name. And it used to be called junk. It meant the companies were not the best credit qualities, but you would charge more interest rate to these companies to borrow money. Today, you see that in private credit, things like this. They might go to private credit, pay a little bit higher, but it's easier to get the loan done. They don't go to a traditional bank. But the lesson I learned was they took something that was called junk for years. It was called junk bonds. Then Michael Milken ended up going to jail. He did insider trading. And guess what? They said, oh, junk doesn't sound too good, and it's associated with Michael Milken, who's now a criminal. And they changed the name to high yield. High yield. How does that sound, high yield? Doesn't that sound much nicer than junk? How many of you want some high yield investments? Or do you want some junk investments? Which one do you prefer? And so that, along with one other thing I realized, that was an observation I made while I was sitting there, and I kind of knew the history. And then the other piece that I had an epiphany about was back in the 80s when I was growing up. How many heard these terms, corporate raiders, leverage buyouts? Do you remember? Carl Icahn, he was a corporate raider. He took down, what was it, Texaco or something, right? Hostile takeovers, right? That's what they called it back then. You know what they call it today? Anybody? It's called private equity. It's called private equity. They changed the name and it sounds so much nicer. So the first lesson, my friends, is Wall Street will change the name on you and they'll keep selling the same thing. Oh, sorry, that's not it. That's not it. I'm going to learn how to use this one day. You could change a few words, create a new meaning, and you'll sell more of what you have to offer. Wall Street does this all the time. They'll do this all the time to you. They'll sell new things. The new hot thing comes out, and it just always happens like that. So my point is you have to be careful. And I'm not saying private equity is great. I'm just saying they took something, they changed it, and they'll sell it. So then from there, what happened was, what I realized was we were on this trading desk. So what would happen is the bank would commit money. They'd say, we'll loan $800 million, back when that was a lot of money. You know, nowadays that's nothing. They talk about billions and trillions. But back then, that was considered a lot of money. And they would lend the money and then they would send it to us on the syndicated finance desk. And they say, go sell. We don't want $800 million on our books. So we do a syndication. How many of you have done a real estate syndication, or you know what that is? You're syndicating. So they basically say, let's get all the banks together. We'll have a meeting. And when we make the loan, you'll take 20 million. Bank A will take 50. So we'd sell the loan. You understand? So we'd syndicate it. So we didn't take all the risk. And then what would happen is one day we'd have loans and the risk management guy would come around and he'd be like, you got to get these loans off our book. They didn't like them anymore. So we'd keep our share. We'd keep maybe 50 million or 100 of that 800 and we'd sold the rest off. And then they say, you know what? We need to get this off our books. They don't like it. Something's going on with the company. And so they'd send it to us, and we had a secondary loan trader on the desk. Now, at the time, that was a new business in the late 1990s. He was a young guy, and he was a very good talker, really good talker. So he'd get on the phone, and he'd start banging the phones and try to get rid of these pieces. So he would get rid of a piece. And I remember one time, he sold this loan off, and it was basically a dog. I hate the word the dog because I love dogs, but it was not a good loan. It was not a good loan. He sold it to the bank. So guess what happened? Anybody want to guess? Eventually, 6 months later, they called up, not happy, the bank that bought it, because they stopped paying the loan. They stopped paying. And so now it was in a workout situation, they call it. But meanwhile, we had dumped this loan on the guy. And back then, they didn't call up yelling or screaming. They were just like, it was all very friendly. Everybody was very well, put together. And so they would call the guy, I'll call him Chuck. I'm not going to tell his real name. I'll call him Chuck. But Chuck said, then I saw the meetings happen. Chuck would go to the head of the desk and be like, look, this guy's pissed off. We loan him, we gave him this loan. And so basically they said, all right, tell him we're going to give him a piece of something else that's going to be good for him. And so he called the other guy back, blah, blah, blah. And everything got sorted. And in that moment, I realized the secret too, which is, this is how Wall Street operates, folks. Everybody must do deals. You must maintain the flow of money and you must generate fees. So people would buy stuff. It was like mediocre. There was not a, it was like, okay, I'll do it. And that one didn't work. So we'll do another one. Because if you don't do anything, you're out. If you're not doing, it's about the transaction, not necessarily about the best investment. Does that make sense? Because they had to just keep it flowing. They had to keep it flowing. So that was lesson two. Lesson two I learned when I saw Chuck. We kind of skate his way out of this bad situation. And it also actually brought me to lesson three pretty quickly because I realized this other truth, which you have to be really careful with, folks, is Wall Street will sell customers anything they wanted to buy as long as it's legal, regardless of whether it was really in a customer's long-term interest. And I sort of realized that while watching these transactions. And how does that affect you? Because what happened in the dot-com bubble? How many remember dot-com? So they sold all these internet companies. Why? People wanted internet companies. And some of them had no revenue or nothing, and they went to zero. And a few made it, as you know, and then a lot more came out later after the crash in 2000. But what's happening today? People love quantum computing. They want nuclear. They want AI. You have all these companies, especially in quantum and nuclear, they have no revenues, nothing. Now, maybe they will once they get to that point, but they trade at high valuations. But the bottom line is, I'll give you another one, electric vehicles. A few years ago, electric vehicles, Tesla, clearly the best of that breed in the US. And then they came out with Lucid and Fisker and Rivian, and they sold to the market. And some of them are a little bit, Fisker went to zero. Several went to zero. Let's just say that. But the market wanted EVs. The customers wanted to get in on the action. You have to just realize that's going on all the time. So when you see stuff coming out, just because it's offered, just because it's a public stock, doesn't mean that that's necessarily good in your long-term interest. You wanted it, they'll sell it, period. Just got to be realistic about that, folks. Anyway, I learned that lesson early. And I hope you will learn it now as well. And then, so what happened then? And I'll just bring that around to something, because I hate to talk about crypto, but whether it goes up or down, the bottom line is you have like when you see somebody like Jamie Dimon, he goes on TV and he says it's a fraud and it's a pet rock, a digital pet rock. But then you go, well, JP Morgan will allow you to hold Bitcoin. You say, he's just lying. He loves it. He's actually lying. I heard somebody say that. He's lying to talk the price down, which I think is not accurate. But think about his position. Let's say he's got all these private wealth clients and they want Bitcoin. Now, you're not going to offer it to hold it because they wouldn't custody it before. None of the banks would allow you to custody to have it on the firm's books. They wouldn't allow it. But now, if I got a lot of clients who want it, if I don't offer it to them, what's going to happen? They're going to go to the next bank and they're going to shop around. So even though I hate it, he says he hates it. He thinks it's awful, whatever. But and then he still offers it. So it's a contradiction. So don't get caught up in that. And so that's, just an example of how that happens. But it happens a lot, folks. And so just be aware. They'll sell it to you if you want it. So don't think that it means anything. So now as time went on at Credit Suisse, by the way, it was a great place. I learned a lot. But one year at the Christmas party, they played a game, and it was a funny game. One of the guys put it together. It was called "Who Wants to Be a Billionaire?" It was a take on "Who Wants to Be a Millionaire?" And it was just a joke. And basically, they would they had like a presentation book, and each page would say things about one person in the department. It was like a joke. This person's, you know, whatever. And you would have to guess. The game was you'd have to guess who the person was. So they came to me, and I was a junior guy on the desk, and they said, one of the things they said was, he's a slumlord. Now, at the time, I had just bought a couple properties in Queens, New York. So I'm working in Manhattan, big fancy Manhattan, and I'm buying properties out in working class neighborhood in Queens, small apartment buildings. I scraped money together. I wasn't making a lot on the trading desk back then. I was the junior guy there. The guys I worked with were 10 or 15 years older. I'm in my 20s. They're making a lot of money. I'm doing a lot of grunt work, but I learned a lot. Anyway, and they taught me a lot. They taught me how to evaluate businesses and financial statements and things like that. So anyway, they had this thing at the Christmas party, and they said, he's a slumlord. And so that was the joke. The joke was, because what was going on in 1999? The dot-com bubble. This was Christmas 1999 they did this. And that was the height. The markets peaked at March 2000. So it was a few months before the peak, but everybody was getting, and it was really hard for me. That was another, there's another lesson in there, which I always talk about, but I didn't get caught up in it until the last few months. And I ended up buying one stock, Healthion. I wrote it from 63 to 11. How many remember the details of a painful experience? That was a painful experience for me, 63 to 11. And I had lost a bunch of money. But that's a side lesson. I always talk about that. These other ones was that I realized at that moment, because they would make fun of me. They were nice people. Like, they weren't like being mean to me or something. They were just, needling me a bit, because they were all doing .com stocks, and I'm buying boring old properties in Queens, New York, a very uncool kind of hip place at the time, whatever. Maybe some would consider it. So I was buying those, and they're calling me slumlord and making fun of me. And I realized in that moment, among the other things that were going on, was that because everybody wanted to be in the hot stuff. And I realized in that moment, people want to look good and have a strong desire to move towards what is hot in the moment. They can't bear to miss out. And that's how the bubbles form. So they're all in the .com stuff. By the way, these people are supposedly, they say Wall Street, the smartest guys in the world, or whatever. They're supposed to be the smart, but they're just hopping on this bubble like crazy. Like, I would watch every day. Guys would be looking at their accounts. Stocks are going up $10, $20 a day. CMGI, Juniper Networks, Yahoo, eBay. How many remember this? Stocks were going crazy. And they were all in on it. Me, I'm buying properties. Nobody cares about real estate. Literally nobody. It's not like today. Everybody thought it was silly. And guess what that means when everybody doesn't like something and ignored? The prices were good. The prices were good. So that's how I became a contrarian. I've always had a contrarian streak. I get uncomfortable actually when everybody's talking about something like in a really enthusiastic way. That's what made me super uncomfortable with the Bitcoin early on. It's gone up, but I had people say, I would just ask one question: can anything go wrong? And they'd be like, no. And I just know that from every investment, something could go wrong. There's always something that could change your thesis. So I always have a healthy dose of humility when it comes to picking the investments. And I suggest you to too. So then, as time goes on Wall Street, how are you enjoying my story down memory lane? Okay, good. So as time went on, I was put through the credit training program. I think I told you. It's basically what the analysts went through. I did it backwards because you're supposed to do that first and then go on the trading desk. But somehow I finagled my way on the trading desk. And then they were like, well, you should actually learn how to evaluate companies if you're going to be on the trading desk with us. And they wanted to send me for an MBA. They said they'd pay for it. It was pretty cool. They offered it. I didn't do it, by the way. But it was cool. And so I'm getting credit training. I'm learning all this stuff. And then so I'm starting to pay attention a little bit more. So when we did these bank deals, remember I told you we had to sell the loans off? So in order to sell the loans, the investment bankers and analysts would put together presentations, right? And then we'd have a bank meeting at the Credit Suisse. Credit Suisse is at 11 Madison Avenue. It's now called UBS because Credit Suisse also made some bad decisions and really screwed up about 2 years ago, and now they're bought by UBS. But it was a whole city block, that building, an entire city block. It was actually, if you ever go there and look at it, it's the same kind of base as the Empire State Building. But the Empire State Building, and it was built during the Depression, they didn't have the money to finish it, so they cut it off at like 30 floors. But it's literally, that was the base of the building. It's a beautiful building. And so we had a room there where we'd do bank meetings. And in the bank meetings, they would go over the projections, why to buy these loans, all the bankers. They would tell them, here's what you're going to make, here's the interest rate, here's why you're going to get paid back. They would make the case, and then people would commit to the loans to buy them. So that's how it worked. But in the process of doing that, I watched the analyst. So I was on the trading desk. The analysts were on the other side of the floor, and some investment bankers were on my side. So the analysts would come over, the investment bankers walk by with the presentation, and then they get sent back, and then they go back, and then they get sent back. And this could go on for days and weeks. And so what they were doing was they were tweaking the spreadsheets, basically. Basically what they're doing is saying, because when you make a projection, and this was the lesson, when you make a projection, I can make up anything really. I mean, it has to make some sense. But so they were making it look better. And that's when I realized, and this helped me a lot, because anybody who looked at any real estate syndication deals in the last few years, this was a big problem. They made the spreadsheets look good, but the reality was not that. And the secret really was, I can make, and I can do it now. I learned you can make a spreadsheet look any way you want. I can change a couple numbers, I can tweak it, and it'll look good. But if a couple of those numbers are changed, that might make look good to not good at all. So it's very, very unreliable to look at projections, or how many of you heard the word pro forma? Pro forma. Pro forma means ain't done shit yet, but I hope it happens. That's what pro forma means. Okay. So if you're not clear, pro forma is basically saying, here's what's going to happen in the future. Nothing's happened yet, but this is going to happen. I'm sure of it. It's not a great statement either. But anyway, so that's how it is. So that was the fifth secret of my time on Wall Street. So I think if you take those lessons, you will avoid so many problems, and you could see realistically what's happening and not be in the matrix of the moment. Does that make sense? How many got what I was saying? Y'all get it? Raise your hand if you get it. Or if you don't get it, no, come on, guys. That's harsh. Okay. All right, next thing on the agenda. So I'll do a Q&A. Actually, do I have that sheet, Wanda, somewhere? Where's it? Can you send it on the WhatsApp?
I
I'm going to
think
go through
WhatsApp.
questions. This might be my shortest call of all time. Oh, here it is. I'm going to get to it in a second. But so, by the way, if any of you are interested in the process of picking investments, how to pick them, I have a group called the Masters Group, right? And I'll just tell you about this for 2 minutes before I get into this Q&A. But the Masters Group, I'll just show you 2 slides on what we do so you understand. Because it might be interesting to some of you if you really are picking your own investments. I say in the book, actually, I say, you probably shouldn't pick your own investments. But if you do, you need to read this book. This is really key stuff, but basically do understand, learn how to take advantage of markets instead of being manipulated by volatility. Manipulated by volatility means when markets go up, you're really excited and you jump on exactly the wrong time potentially. And when they're going down, you get scared and sell everything when you really should be buying. Possibly. We learn how to value business. This is the key. It's like those two pieces are the key. Understand markets, value businesses. That's what we do over and over again. I gave you stock recommendations. I gave a lot of stuff that went up a lot this year. You can bring your real estate private deals in for analysis, or people ask about stocks, so you get feedback, so you don't jump off a cliff by yourself and then realize later, I didn't have a parachute. We could say, hey, maybe you should have strapped that parachute on, or maybe you shouldn't have even been on that cliff. And we have a great like-minded community and a lot of friendships within the group. Basically, we get on the call twice a month. It's 1 year long, 1 year. And we're going to do two trips this year at least. Although I'm hoping we could do this third trip. The first one's Berkshire Hathaway annual meeting. That's Warren Buffett's company. Although he's retiring, we're going to go. And I might be the last year we do it, depending, because everyone used to go to see Warren Buffett. And you'd hear 6 hours of Warren and Charlie talk. Some of you went with me over the course of the last 3 years I've been doing this. We always have a great time, and it's always a massive learning. And then we go to, this is what they call the Summer White House. I was a member here before he was president. I know sometimes anytime you say the word Trump, there's always a small percentage of the audience that might pass out. And so I don't want you to pass out or get upset. But it's just a golf club. And we don't do a political thing, but we get together. I'm a member there, and we just get together for 3 days, and we value businesses, and we always get great ideas out of that meeting, and we have a great time, and we play some golf a little bit. And then I'm hoping that Musk said, because Tesla's a theme that we kind of like, which you have to understand more about, which I might do a whole thing in January on AI and robotics and the best way to play it, because we talk a lot about it in the Masters group, and I feel like it's one of the strongest theses that we have. But there's more to it. You shouldn't just buy anything. You shouldn't do anything I'm saying on here. By the way, I forgot my disclosure. I'm not a financial advisor. You need to talk to your financial advisor. Anything I say is just my returns. That doesn't guarantee anything in the future. So please just don't take that, because you all have individual situations. I don't know your situation, what's appropriate for you. So we're just talking generally for information purposes. But if Tesla does the annual meeting at a big venue, I really want to go to that. That'll be fun. So other than that, that's basically that, and we'll get into the questions. And you can also post in the chat, or you can raise your hand. Oh, Don. Well, the secrets will be in the book. But yeah, we'll go over it again on the Masters. Don's in the Masters group. I know some of you are in that group. And we can go over it again. I'll give it to you. But really, folks, I think that's like, it's super, super helpful to sort of be realistic about how the investment world works. Now, on that note, I just have to format this a little bit different, so just to make room on my screen here. So give me 1 second. We'll just play a song while I do this.
Hey, said our hustler's work is never through. We making it 'cause we make it move. The only thing we know how to do.
Actually, before I get into this, questions. People always say, well, I'm talking about the Masters group in this way, and, is that really, what do other people think? So I'll just share with this really quick, if you don't mind. Watch this for a few minutes. Then we'll come back, we'll do the questions. This is about the Masters group. And again, when it says, I always find this, that's me. I'm not saying I'm the ultimate investor. I'm saying the ultimate investor will evaluate stocks.
What I really love is the group of people that ends up showing up. Everyone's high-level players, and really, just like Tony says, proximity is power.
I think why it's so valuable is because it's such pragmatic, simplistic advice, but yet so few people will actually follow this advice.
What David is teaching here is something just timeless.
I love his style of teaching, and I really appreciate how real and authentic he is with what he shares. You can tell he shares from the heart,
from his good experience and is really just here to help all of us become better investors.
David has an immaculate way of looking at how to approach the markets in a way that's systematic, way that protects your money first, way that shows you how to get opportunities, how to identify your opportunities where you can maximize your win and minimize your loss.
As you apply the framework, you can make better decisions more often and avoid bad decisions, which means you get to play the game at a higher level longer, which is great for everyone.
I come from a real estate investing family, and I think it's interesting that you could still be in level 1, and then part of you can be in level 5. So that was one of my favorite things to learn. Well, I love the underwriting. Like I said, I've been doing real estate for a while. I love learning new thoughts and underwriting. And I think that the way he teaches the underwriting is way more conservative, which I think is really appropriate for the market that we're in right now. I think anyone that's even remotely interested in real estate investing would benefit, because David teaches you the basics, and then you get to decide how to use it. So anyone has the slightest interest would be amazing.
As a small business owner looking to build a portfolio, invest some money, it's really easy to get overwhelmed with all the stuff that's out there, what to invest in, what to do.
I would consider myself to be somebody who is a beginner investor. I didn't really know what I was doing in the markets. Ever since starting in David's group, I've appreciated just how systematic investing can be. I feel far, far more confident in my own abilities as a value investor.
The way I came across David was through Tony Robbins. We got on a phone call together. I was just going to do the virtual, and he encouraged me to come in person, which has made all the difference. And I joined his master's group, and that's been super, and learning more about deals that I had no idea. Also on the real estate side, completely opened my eyes of how to look for real estate deals.
This seminar has way exceeded any expectations that I might have had. I feel that I'm more open-minded when I don't come with expectations. So I am a farmer, and I feel that it's so important to prep the soil and really set the ground, and that's exactly what I'm doing. I am bringing in all of this knowledge and everything that's here, but let me tell you, the individuals that are here that we share is top-notch. David knows his stuff, and he's able to communicate it in a way that it just sparks all kinds of these ideas as you're sitting there.
So there's actually a big sign in the room that says math is the enemy of bullshit. And I love that sign, because if you can keep emotions out of investing, it makes so that if it makes sense, you do it. And if it doesn't make sense, you don't do it. And it sounds so simple. Just the way that David's broken down how to ask the questions, what questions to ask, what to look for, what kind of markets to look for. I'm excited to be able to take that back to where I'm investing and become an even better investor with just more knowledge.
But what I really liked is that actually there's some certain internal principles that David covers around how to look at investments, how to look at real estate investments. And
getting such a masterclass from a very experienced investor such as David allows you to see what's really out there. Overall, applying this knowledge is invaluable. It's incredible.
One of the biggest lessons is oftentimes life is better with a co-pilot.
You don't know what you don't know, and I think it's invaluable to have people that will tell you what you need to hear rather than what you want to hear.
He's also empowered us with some simple tools where we can actually model some of these things, where we're really cutting out the amount of time which we are spending on trying to analyze deals.
David is the single one person I could share this with you that I would trust to mentor my daughters, and they work in the hedge funds.
It's an extremely unique privilege to be able to learn under David, to work on my own investment species.
Essentially what David has done is to demystify a way in which you can actually analyze space and go after the one which you feel have potential, and then walk that way.
I've been investing in stocks for years, but I've been paying attention to stock prices. And David teaches you to evaluate the stocks as you're buying a piece in the business and you're looking for value. You're looking to figure out like it's worth buying, and then you look at the price. So that's like a major switch that I've made.
I have a finance degree, and all we did in college was study publicly traded companies. And I've never learned throughout my college experience how to analyze a stock how David teaches it.
It's the best investment I've ever made. David, first of all, is honest, he has integrity, and he'll never steer you wrong, and he's not out to sell any product. I love the guy with all my heart, and there's very few people in this world that I would trust with my money or to get advice from, and David's one of them.
I've been in the master's program for about 3 months now. I've learned so much. I love David's way of approaching buying stocks and investing. It's very simple and practical.
I think this is like general. It needs to be for everybody. I believe the only way to make wealth is by investing. You have an income. David did talk about it, and you have an income, but then you're rich. You make it rich only by investing. And I think anybody who has an interest or is getting started in investing, or a seasoned investor, this is kind of transitive for anybody. So I would recommend, or she's like a required learning in my mind.
Does phrase to sum it all up is the math. The math is the enemy of bullshit.
Keep on doing a great job, David.
All right, folks. Thank you. So if you want, who knows that song? See the music people in the room. Jared, what song is that?
It's Limp Bizkit.
You're right. Okay, so if you want to talk to me about Masters, as the last piece I'm going to say on it, there's a link. I think I posted it, wanted to post it. It's in the chat. You have to do a call with me first. We'll talk for a bit because make sure it's appropriate for you and stuff. We curate the group, keep it high level. It's a really cool group. A bunch of guys are on in the group here. Pavlina, Mark, Don. I can't see everybody, but anyway. So now let's get into the Q&A. Stacy was in there. I can't see everybody because there's more people here. All right, Q&A. All right, let's get into the Q&A. No, we're not going to do that. What song was that one, Jared?
Same deal. I don't know the name of the song, but I know the lyrics.
All right, we're not doing that. Okay, here we go. So current market perspective. Everybody wants to know exactly where the market's going to go. I could have just done the call. Could have just start at, thanks, Don, for writing that about the Masters Group. Appreciate that. But I could have just done the call with stock tips. You just want stock tips. Come on, be honest. Tell me you just want some stock tips. Okay. All right. But anyway, markets are very high in terms of valuation, historically speaking. But why can it continue? It can continue, in my view, because they're cutting interest rates. And you should learn this phrase. You can write it down. All investments compete. If interest rates are low, a lot of things go up and other things become more attractive. Because if you get 0% interest in the bank, how many remember when you put your money in the bank and you got nothing? And then what happened? All of their assets went up. So people can't get any yield. So they start going up the risk ladder, as we call it. And then they start thinking, oh man, a real estate deal where I get 5% is a good deal because I'm doing 0 over here. And so it forces people into assets. So when rates go down, it forces investors because you don't want to sit with small yields. So if they keep lowering rates, that can have a fueling effect to the market. Although a lot of it is priced in. That's the other thing you should know about markets is they price in advance. So a lot of things people say, well, AI is a big thing. Everybody knows about AI. There's literally not one person left on planet Earth who doesn't know that AI is pretty awesome, impactful thing. There's no one left. Okay. That doesn't mean the stocks can't go higher, but a lot of it gets priced in. So people buy NVIDIA. So there's some of these other questions because I'll just sprinkle around a little bit. A few of you asked, like, how do you value something? How do you value something? Value stock, value an asset. The value of the asset is the cash it produces. So if you think to yourself, I'm going to lay my money out today for a stream, for an income in the future, and what am I getting from my money? That's why when you say, people say the stock market's return an average of 10% or so for the last 100 years. So if you put your money, you got 10% on your money, and that doesn't always happen. In fact, at these levels in the S&P, the history shows that the index returns, the S&P 500, are typically lower for the following decade because we've already priced in a lot of optimism, a lot of future earnings into the current stock prices. So the risk is that we're high on a lot of valuation metrics and there's less and less to buy. I find it a little more difficult now to find things to do, although we do find things in the Masters Group. I tell them exactly what I'm doing. And there are a few theses that I really like that are value, that I think are of great value. But basically, you have to do two things. You get with your financial advisor, you make a plan. Because again, this is very specific to your situation. I don't know when you need the money. If you tell me you need money in 1 year, you cannot buy stocks really, because stocks are very uncertain in the short term. They can go up, they can go down. And so if you need that money and then markets crash 30%, that's not good. You don't want to be in that situation. But if you have a long timeline, 15, 20 years that you need the money, then you have more options for buying assets, because the markets will go down at some point again. And I can't tell you when. Anybody who tells you exactly that, I think they're selling something, either investment, whatever, fund or something. But you can watch CNBC. They'll tell you exactly what's going to happen. I don't know. But I can tell you in the long run, I think that, if you look at any history of the dot-com bubble, and what happened was the internet was super useful. We're on it right now. There's no question about it that it was life-changing. But what happened was stocks went too high, optimism got too great, and then they crashed because it was just out of whack. And here's one truth that you can take to the bank. The stock market will follow the earnings of the businesses over time. Eventually they can go out of whack. So if you think like a chart, you have the earnings. Let's say you take the S&P 500, all those companies, and some make more and some make less, but roughly they're going to drift higher over time. There might be some years like 2008, there was a crash, earnings went down, but over time they're going up, right? Basically, you understand that? Now stock prices, while the earnings line might be like that, stock prices can go like this. Sometimes they get way ahead of the earnings. Sometimes they get behind the earnings, and people get very pessimistic, depressed about stuff, and they take prices down. Now, that is a huge opportunity. I always talk about in the Masters Group. If you know what you're doing when markets get depressed, you don't need to make 1,000 great bets in your life, 1,000 great investments. You can make a handful of really good investments when markets and everyone else is scared. So that's the idea. That's the idea of it. And that is the true gift. That's why I love public markets, because the fear and greed plays out in real time. It plays out in real time. And real estate is very efficiently priced most of the time. Now, sometimes you can negotiate one-on-one with somebody and maybe you get yourself a great deal on a property. But in highly competitive multifamily or things like this, the prices tend to be efficient. The stock market will get inefficient at times, and sometimes it gets really out of whack once in a while. If you know what you're doing when it gets out of whack, you can make more in a short period of time than, previous 10 years or 15 years. And that's just the truth. That's just the truth. So that's all we spend our time doing in Masters, is we just keep learning, doing that. I keep going over that. And, my returns and my track record is pretty darn good in that regard. So that answers a couple questions about value, but the value is the income it produces. Now, just to get to address, things that don't have income, how do you get the value? Like gold doesn't have income, but it's 40, whatever it was today, 4,300 and change an ounce. So what is the value there? So that's sort of a perceived or imputed value. So people can use gold. Actually does have some utility. They can melt it down for jewelry. Central banks have used it for centuries as money. So people perceive a value of it. Now, when you get to something like, crypto or things, these are all perceived values. So if everyone believes it, it works. It's like a self-fulfilling prophecy. If you believe it's worth more, and everyone believes, they're very good at, and it goes up. But the underlying asset doesn't produce anything, so that's your risk there if the perception changes. See, if the perception changes on my real estate, I own apartment buildings in New York City. Let's say you all decide New York City is crap and apartment buildings is the worst investment. You all decide, It doesn't affect me at all. I don't need to sell to you. My return is coming from the property. No one has to like my properties. No one. I need no one to like it. I only need tenants. I need tenants. Okay, I'll say that much. I need tenants, and that's it. And that's my return. Do you understand? That's the difference between a productive asset and unproductive asset. An unproductive asset, you need other people to agree for you to get your return. You need other people to believe it and move the price up. This is such a huge point. People have a lot of trouble understanding it. I hope you understand it now. We're not going to do that song. I want you to do the riff. That's it. All right, let's go to some more questions. Oh, somebody asked me in the group here about an advisor. Can you post us social media? Guys, if you take a second, go on the chat and follow me on the social media. I post all sorts of stuff that I don't post in the WhatsApp. Oh, you did. Can you post it again? I have 2 Instagrams. One is my personal, and one is like the business in it. I've been doing a lot of videos up there. Who asked me the question? A few people asked about advisors. How do you pick a good advisor? Well, this is not easy. I would look for somebody, first of all, I would talk to them a bunch and make sure, first of all, you're sort of aligned sort of with what they're saying. Like if they're saying stuff like, we need to get in on the hot stuff and this and that, that's probably not a great thing. They should be. It's funny in the investment world, you see the guys on Instagram and stuff, they stand in front of their jet or their cars. Literally the best investment guys are going to not be, they're probably not going to be that, they're probably going to be really reserved, and they're not good. It's just not, but you go look at Howard Marks or Ray Dalio. They're like super boring type, sort of monotone, but they're like the best guys in the world. Warren Buffett, there's no flash and sizzle. So I would stay away from the flash and sizzle of social media and things like that, and kind of look for the guy who it makes sense. They should be saying some of the things I'm saying to you. They should understand that you're buying pieces of businesses. They should have a long-term view. They should have a track record, a long track record. Their firm, should be around. And it's not simple. I've heard people complain about big companies. I've heard people complain about small operators, but so it's a mix out there. I wouldn't look to your advisor to be like some kind of hedge fund manager who beats the market. That's not the point of an advisor. If you want to get into that, then you need to learn more and try to beat the market or pick your investments. You really need to learn more. That's what I do. If you're just going to you don't have to do that. You can just invest like a retail investor, but just make sure, look to your advisor as that guy who keeps you on track. It keeps you on track, keeps you invested when markets are going down. He's like, hey, you know what? Look, let's keep our heads on straight. What can we buy? So that's the kind of thing. It's almost the opposite of everything that kind of attracts people, as is much of this stuff that I'm telling you. It's called contrarian thinking. You really have to contrare. So there's a lot of questions here about how to get consistency returns. Consistency returns. I mean, markets do what they're going to do. Markets are up 20-something percent 2023, 25% or so last year. This year, it looks like, if it ended here, it'll be up 15 or so, but who knows? In the last couple of weeks, it could go up, it could go down. So that's pretty extraordinary 3 years in a row, very good returns. Now, the more years you have like that, the prices get way ahead of the earnings. And at some point, some people might sober up. I tell you that. People who tell you exactly what markets are going to do every minute, that's just, how many guys have you seen these guys on social media and stuff? They call a crash every year since the financial crisis, actually, they've been calling a crash. There's big name guys. They always call a crash. Some more money's been lost waiting for the crash than the actual crash produced, right? Because you weren't invested. And so it's a tough game. That's something you really need to talk and plan with your advisor so you don't get into that. People asking about the UK. I mean, I just bought a stock in the UK. I told the Masters Group it was trading at 4 times its cash flow. The stock went up literally the next day after I said it, and I don't think anybody had a chance to even buy it. But it went up something like 40%. This was just in early December because the whole world just realized this thing was so cheap. This is what I love about stock markets. I can look all over the world and find things that no one's paying attention to. It was a company that does like cruise lines. And imagine this, it trades at 4 times its cash flow. Now, how many of you own a business or you own investment property? How many of you own investment property? Because the real estate people, you'll get this. Okay, so if your building produces 100 grand cash flow a year, would you sell it for 400 grand? Would you sell your building that produced 100 grand for 4 times? You wouldn't. I'll answer for you. You wouldn't sell it. You'd want 20 times. Maybe more. You want 2 million. Maybe you want more than that. This whole company was selling for 4 times its cash flow. People just, especially real estate people, I always try to needle the real estate people because if you actually looked at stocks, I like it these days. I used to run around buy real estate, do it. I still like it, but I never find any really, really good deals for the last many years. There's too much enthusiasm in the real estate. Maybe it's come out of it now and it's sort of getting negative. But in stocks, I can go all over the world and look at markets where people are they're negative on it. And you could find things like that. You can find things that are just cheap and they don't make a lot of sense. Now, is that business a great business to hold for 10 years? Probably not. But when something's so cheap, you can make money on it. The most important thing is the price you pay. It's not picking the best company. You all know the best companies. I want you to get this point. You could say, well, NVIDIA is the best company in the world. It's an incredible company. But it also made $100 billion of free cash flow and it's worth $5 trillion. Is it 5? I think it's still $5 trillion or 4. Let's say it's 4. If you wrote a check today, let's say you had unlimited funds. You say, I'm going to buy this company. I wrote a check for $4 trillion. This is how I think about it. I think I'm going to own the whole business. And I'm going to get 100 billion. So it doesn't matter. Forget the trillion billions. The point is, if I gave $5 or $4 trillion, what would my return? What return would I want? How much would you want return on your money every year? Would you want at least, I mean, it's a great company, so maybe I'll take less because it's growing a lot. Maybe I'll take 200 billion a year, as long as it's growing, because that's only a 5% return. You all get what I'm saying? How many follow? Okay, because this is a very important point. So NVIDIA is a great business, but, or you could look at Palantir. Palantir was trading at, I think it was like 400 billion, and they were making $1 billion a year. $400 billion company, and you're getting $1 billion. So you're getting very low return cash flow yield. And so that's how you have to look at it. Now, Palantir could grow. So why do people buy it? Are they just all stupid? NVIDIA, they're predicting that they're going to grow so much. But what happens is they're predicting, I think, a little too much, especially with NVIDIA, because NVIDIA is the leader, but how many competitors do they have now? Everyone's making their own chips. Google's making their own chips. They're called ASIC chips. They're very specific. They're not the same, but they can use them for AI. Tesla's making their own chips. Google, Amazon. AMD is competing with them. So you have all these companies. And so if you're going to pay $4 or $5 trillion for a business that makes 100 billion, that 100 billion better grow a lot. And I just don't know how you get there on those numbers. And that doesn't mean the stock can't go up. Why? Because the casino is operating. 95% of the people aren't even talking about what we just talked about. They're just in the casino. They're like, I want to get on NVIDIA. Everybody's on it. And my neighbor got rich. He's an idiot. Why is he making money and I'm not? This is how people make investment decisions. My neighbor's an idiot, and look how much money he made in something. I got to get in. I am way smarter than that guy, and he's getting rich. This is how people make investment decisions. It's crazy. You know, people spend money. We all do it. This is not crazy. It's like human nature. And I don't do it anymore. Maybe way back in my 20s. That's what happened to me when I bought Healthion and rode it from 63 to 11. I couldn't take it anymore. Everybody was getting rich but me. Anyway. All right, let's do a couple more questions. Any, you can raise your hand too if you have something. Look for the guy that pretends that don't have a jet. I like that, Ralph. So people talk about hidden fees and costs. Well, that's an interesting question. I mean, if you own stocks and stuff, you don't have that. If you own an index fund, they have very low cost index funds. There's basically no charge. If you start buying elaborate products, then you get into more fees, and you really have to understand it. I would get it in writing from the people and who are selling you that. Somebody asked stocks or real estate. Well, I like stocks these days, but when everybody likes stocks, I'm sure it'll be high again, and they'll all come piling in. And we're sort of in the euphoric phase, which is sort of, that can go on for a while, but it's sort of a high phase, sort of one of the last pieces of sort of a big bubble, but it can go on. We're in a bubble in many things, but that can go on, and some things are still can be found here and there. What's a balanced portfolio if such a thing exists? I think the way I do it is different than probably people teach. People teach balanced portfolio, and they say, well, I'll buy a little bonds and I'll buy a little of this and I'll buy a little of that. It's like going to the buffet at the all-you-can-eat buffet. I'll have a little bit of salad and I'll get some chicken, I'll get some protein, definitely have some dessert. And so they buy the investments like that. Now, that's not necessarily bad because, again, that's something you talk about with your advisor because you have a different risk tolerance maybe. You don't like when things go down, then you can't own stocks. If it's going to bother you and you're not going to sleep at night, if a stock goes down that you own, it's hard to own them. And you shouldn't. There's nothing wrong with you for not. But you might want to try to train yourself to be more, have more equanimity around it because the stocks have been a great thing historically to own to produce investment returns. But you have to be honest with yourself about your own risk tolerance, about what you can withstand and can't. And that's something you do with your advisor because that's a personal thing. And you have to be truthful with yourself. The biggest thing is the temperament and emotions. A few people asked about that in investing. What I just told you, a few things about cash flows and stuff, none of you needed to go to business school to understand, well, if I outlay, if I got a company that's producing, I'm paying the whole price of the company, I'm getting is only 4 times its free cash flow. That's the cash flow that could be distributed to the owners. That's pretty good. You didn't need to go to business school for that. Now, you might want to understand that business more. Is it a good business? Is it a sinking business? Because a business that's going out of business might look good 1 quarter, one month, 1 year, and then it craters. So you have to make that judgment. But that's relatively not that hard after you learn a few things. So that's all stuff. But the big thing is the temperament. Do you get caught up when everything's going up and you get super excited and you're jumping on at the last minute? How many ever jumped on like I did in 2000 at the last minute and rode that thing down? And then you go, what the hell happened? And and think about why you did that. You couldn't take it anymore. That was an emotional thing. It wasn't, you did no analysis. Let's be honest. I didn't when I did it. And so it's just an emotional thing. Like you just you just get caught up. And that is the big, huge thing in investing. How many times have people come in the group and they're like, well, I did this real estate syndication. Everybody was doing it. The room was packed. The seminar was packed. Everybody was in. And then guess what? They made the spreadsheets look however they wanted. One of those, and it's not hard to do. And I did the deal, and now you're stuck too. See, the real estate thing is tough because you can't get out. You can't just push a button. If you're in the stock market and you made a bad judgment, or you had a moment where you bought something and you realize, you know what? I bought that thing. I don't even know what the hell that company does. And I don't really know why I own it. And I don't know enough. You could sell it. This is a great thing about stock market. Instantly, you could do even billions of dollars of business like that. In real estate, you make a deal, and I like real estate. Don't get me wrong, but think about this. You make a deal, then you have to negotiate the deal, then you go into contract, and then maybe the deal falls apart. You're buying an apartment building or something. You spend months analyzing it, and then you realize, oh man, they fudged the numbers, or this wasn't what I thought, or I realize I'm paying too much, and the whole thing falls apart. At this age of my life, I like just sitting here in front of my computer. I can play a guitar when I'm tired and take a break. And I can look at businesses all over the world. And I enjoy it though. So maybe you wouldn't enjoy that. So that's also you have to be honest about. But, I can do investments like that sitting in my office here and I enjoy doing it all over the world. Real estate, I got to get in my car, drive and go look at the thing, make sure it's there. You look at numbers first, but you always want to go kick the tires on the real estate, right? You want to go out there. If you don't go out and see your real estate and buy it, good luck with that. That's not going to be probably a good result. It's probably not going to be a good result. All right. I'm rambling a little bit, but I think I'm covering a bunch of questions. If I didn't cover a question that you had, then just you can also just put it in the chat. Predicting the economy. I'll just say this because some people are asking, like, will we have a recession? Will housing prices go down? I mean, I think that's a really localized question depending on where you are, but roughly speaking, rates are lower. It helps real estate. There's shortage probably in real estate, but in some cases things were way overpriced, so they might come down. So it's really a localized sort of piece when you talk about real estate. It's different areas, different markets. But I will just say this, trying to predict the economy is like, it's a tough game. Like, I wouldn't do it. Here's what you got to know. Sometimes the economy is with you. You got the wind at your back. Things are good, rates are low. Sometimes it's a headwind. How many of you own a business? Who's own a business? Some years are better than others? Or it's always gets better every year? So what do? You just adjust. Sometimes conditions aren't great. You work a little harder. Maybe you make a little less. Why would you think your stocks wouldn't be like that? Or your investment real estate? I've owned real estate for 28 years. Next year will be 28 years, so it's 27 and a half years. So I've owned real estate for that long, and I always see projections on real estate, and it always says it's going up 3% a year. I remember the spreadsheet? That's how they make it look. 3. I saw one, it was 3, and then it went to 4. Somehow in 6 years, they knew it would go 4%. I was like, wow, that's amazing. They got a good crystal ball. Mine doesn't work. And I'm always like, that's not my experience. 2008, what happened? Well, the rents went down about 10%. It wasn't that bad. Didn't hurt me because I had the properties at a good price. I wasn't over leveraged. So it didn't bother me. People got hurt, had too much leverage and no cash flows. Okay. Then 2014, I'm in New York City. They get a new mayor, Bill de Blasio. That was pretty much the top at the time of the rents. Then he started having sort of bad, like negative sort of policies against businesses and real estate owners. So rents didn't go anywhere for like 5 years. From 2014, 2019, I finally got to new highs on my rents. Finally. That's just life. And you know what then? What happened the next year? The pandemic. And my rents fell 30%. I remember when we had apartments that were $2,900 a month I was getting for these 2 bedrooms in this building. Roughly $2,900 depending on the floor. And all of a sudden, mine were older walk-up buildings, so they're not like fancy new buildings. And all of a sudden, the agent calls me. He's like, I've literally got no calls. This was in September 2020. So there was like, I don't think there was anybody left in New York at that point. Everyone left. I had left. I left in April. I went to Florida. I never went back. I'll just go for a weekend here and there. But they called me and they were like, I said, so what's the market? I said, go look at the list. Everything was at $22,000, $2,100 a month, similar apartment. I said, just lower the price and rent it. What are we going to do? Argue with the market? Like, I'd rather just rent it. I'm going to sit here and argue. That's life. Sometimes but here's the problem. If the economy is bad and you're super leveraged and all your spreadsheets showed that you were going to make, and everything had to be priced to perfection, then yeah, you have a problem. But I never did it like that. That's what Warren Buffett, and he learned from Ben Graham. He said, you have to buy things with a margin of safety. I like the word cushion. I like a cushion just in case it doesn't go well. I'm not going to get taken out. So the optimistic projections is what gets people. That's why when you buy a stock that trades at 1% free cash flow yield, you are expecting perfection from that company. You are expecting perfection. I don't like that, because how often are things perfect? Not often. Actually, we had a period where people got trained where interest rates were zero for like a decade. That was like the most perfect conditions for assets, because everybody went into stocks, real estate, and they all went up. Everything went up. And so we got trained that, and now, it's been a few years of higher rates. People are starting to realize that's not how the way things work. All right, let me get this question here in the chat. Oh, thanks, Mark. I see you wrote this thing. I've been an investment advisor, financial planner for 27 years. I'm still part of David's master's group. For 3 years now, Mark's been there. Honored to have Mark in the group. He says, because the best investors never stop learning, and David delivers wealth building principles you won't hear. No product, no hidden agenda. Thank you. This question from Kimberly. What's your thinking about gaining liquidity now in anticipation of upcoming investment opportunities? Like some of the bigs are doing. I don't know what other people are really doing. When I see people have cash, unless they said I'm raising cash, but sometimes people have reasons why they have cash. People say Warren Buffett's got $300 billion of cash. He's predicting a crash. I think more of it is like he doesn't have anything to buy. And why? And because prices are too high. And if prices are high, he's not going to buy it. So he ends up. So which came first, the chicken or the egg? Like did he get the cash first, or he had the. So I like to think of investments this way, in 3 buckets. 3 types of value investing, I call it. Is it a company that you love? It's a great business. It's a compounding business, and maybe the price is high. But, to sell something like that, you may never get to buy it again, and now you paid the tax. So that's one category. So this is a business that I call these 3 types of value investing: 1950, 1980, and 2010. Don't pay too much attention to the dates. But a great business at a fair price, I don't want to sell it just because markets are high, because I might never get it again. And, maybe it won't be good. Again, maybe the economy will be bad. That company, the stock won't do well for a couple of years. But over the long run, that's a great business. And I don't want to give that one up. That's a lesson I learned, and by a lot of mistakes, selling things I shouldn't have sold. And you never buy them again, really. You never gets really opportune. Or maybe you do, but it's hard. Anyway, so if it's in that category, I'm not trying to raise cash because that's a great business. If it's in a what I call 1950, it's just buying cheap stocks. They're cheap assets. They're not great, like long-term compounders, but you can buy. You can think about this in real estate. It's like a really crappy building, but it's so cheap. You're like, you know what? I'll fix it up. I'll rent it out, or I'll sell it. But I don't really want to own this thing because it's not in the best area or whatever. But you can make money doing that. It's a little bit harder, a lot of in and out. But I find stuff like that, and we talk about them in the group, and they work. So that's one. If you're not that crazy about the business long term and it's up, maybe you sell it. And then the third type is what I call value 2010. That's when we got into technology, and you see the future of a business that's not reflected in the current economics, but you have a pretty good reasonable expectation that the future cash flows are going to be way higher than they are today. And occasionally you find one or two of those. And I wouldn't necessarily, I might trim around that because sometimes those companies are volatile because they're all priced in the future. And it's like, some days people are like, oh man, the future is going to be great. And then they're like, wait a second, maybe it's not executing because it's not based on the current businesses. You know, Tesla's an example of that. It's like, why does it trade here? Not because of the cars. The car company is the most overvalued company in the history of the world, the car company. But they're betting on the robo-taxi business because that's the economics of that are really good. Will throw a lot of cash flow off. And they're also betting on the Optimus robots, which might be the biggest product of all time. So that's how I think about it, whether to sell or not. Is it a crappy business that I just bought cheap, it went up, and it's not a long-term hold? If it's a great business or great property, like I still hold my properties in New York because they're relatively good. And they've compounded like crazy. And I don't want to sell that because I'll never buy it again. But, you know, I'll never say never. I never say never, but that's my idea. And then if I'm betting on something of a future, which again, you get a lot of trouble betting on a future of a company. You're like, well, they're going to be big. Like these nuclear companies, it's wild. They have like $20 billion company. They have no revenue. It's like, well, once they turn the switch on that nuclear plant, they actually will have a lot of revenue. But is it worth 20 billion? Like, I don't know. So that's where people get a little wild. Or these quantum computing. Have you seen these? Some of these stocks have gone up like crazy. And it's like, well, they don't have the technology yet. But maybe one day it's like ChatGPT. They turn the switch and it's like, boom. But, you know, there's a lot of optimism in there already. So I can't tell you if they're good or bad values, but I don't like those type of things. Whereas if I look at Optimus robots, I can kind of see a world where robots are roaming around. How about you? Like, I'm pretty sure there's going to be a lot of robots. And from what I can tell, Musk has the lead in terms of the hand movements of the Optimus robot and the AI stuff. He's sort of got an edge there. So that's a whole nother conversation. But anyway, that's how I think about, you know, selling. I don't really think I'm going to raise crash because I'm predicting a crash because it's really hard to predict crashes, really. Now, I will tell you a situation where I would sort of think, like, let's say you had a parabolic sort of stock market where, again, it was like late 90s, early 2000, where everybody and stocks were just open up every day. We've almost had that a little bit for a while, then it calmed down. It's like if I see something going straight up for a long time and I'm like, look, this makes no sense. I don't like this business long term anyway. I might just sell something into that, but not everything. I'm invested. I'm pretty much fully invested. I have some cash because of other reasons, but hedge strategies, real estate. Hedge strategies take advantage of. Look, here's how I think about stock. I said this to my group in January, almost a year ago, early January 2025. I said markets have been up 25 roughly percent the last 2 years. Now I can't tell you what's going to happen, but then the new president had come in and his policies were very different than what was there. So some of his policies, I was like, probably caused disruption, you know, tariffs and stuff. This was in January. I didn't realize he was going to do what he did and that it would fall as quickly as it did. I didn't predict that, but I just thought what he's doing is trying to change the whole like way we create revenue and all this stuff. It was totally disruptive to the system. And so I said I wouldn't be surprised if stocks fell, but I cannot predict that. And I'm not going to sell and sit on the sidelines. Now, look, if you did that, you know, you missed another 20%. It went up, or 15 right now. The point is, what I said to the group was, if you buy value stocks, and I gave them a whole list of things that I thought were pretty good, you might see that when the markets fall and people are selling the hot tech stocks, those value stocks might even go up. And at the very least, they probably won't go down as much. So what happened? Literally 3 months later, the president said this thing about profit liberation day, the tariffs. Okay, so you announced the tariffs, stocks sold off because the market was like, what? This is crazy. This is way higher than we thought. So it took people by surprise. And I had recommended stocks like Dollar General, which went up. It's now up 70%. I recommend other stocks in Brazil, what trades here, ITAU, the bank, things like this. Other stuff had gone up. And so when I showed you my returns, I only fell 10%. The market fell 20%. So that's how I don't think of it as a hedge. I just do the same thing every day. Try to find stuff of good value. If you do that, you will just I call it natural diversification. You will naturally not be in all the hot stuff. You will naturally be in other stuff in other industries. I call it natural diversification. And it's only because I just focus on valuing stocks. I'm not playing in the casino. I'm not in the casino. And that's that. So that's how I look at it. I get a natural hedge, sort of what people call a hedge. Okay. All right, we'll wrap this up. Oh man, it's 6:30. Holy cow. All right. I see a few my master's folks in here. I'll answer your questions. Pavlina, how can we get macroeconomics and policy separate from investing decisions? Just ignore them. Just ignore it. Stocks have gone up under Democrats. Stocks have gone up under Republicans. We can sit here and yell at each other about which we like more. It doesn't really, some things will do better, different policies. Again, I just look for great businesses at good value. And then if the economy's bad, one president does something you don't like, or it's bad for that industry, another one comes in. They go through phases. Why should it be any different? Why should it be perfect? If it was perfect and there would be no profit to be had. It would just, so the perfection, the key is to just be that person, which you are, and you're in the group, and you hear this stuff all the time from me, pretty much, I guess. But it's like you're just sitting outside there in the Matrix. That's like the Matrix, the bullet comes and he moves real slow, and the bullet comes and it's just like, oh, that's what's going on. And if you just focus on value, I always give the analogy of golf. How many play golf or have played? Or how many have just gone up to a golf ball and just tried to whack it? You went to the range. You just try to swing as hard as you can. How many have done that and hit the ball straight? It felt good, right? Come on. How many have done that and the thing went off into the, and you just dinged it, or it went like 3 yards. And you're like, okay. So a lot of people in stocks and investing, they go and just try to whack the ball all the time. If what really works in golf is you sit there and you think, you first train for a while, you train, you learn, and you think about your swing, your stance, the boring stuff. You think about your swing, your stance. You think about, am I going to follow through? When I follow through, like, am I going all the way through? Am I picking my head up? When I hit the ball, keep my head down. So when you're learning, which I'm still like mediocre golfer, so I still think I have to keep my head down, don't lift your head, swing. And guess what? If you do that over and over, you play pretty good golf. That's investing. I just do the same thing over and over. I don't think about the market. I'm not trying to whack the ball. I'm just saying, all right, what's this company? Can I buy it at a good price? Is it worth owning? Is it a value 1950, a cheap stock that I'm not going to hold forever, but it's just so cheap I can't ignore it? Or is it a value 1980? Is this that opportunity? That's ideally what I want, is those great businesses I can own forever. Because in the end, if I can pick off only 5 or 10 great businesses and own it forever at good price, I can buy them at good. That you don't need to do much more than that. Why should you have to make you don't have to make 100 great investments. You have to make 1,000. You could just own this S&P 500 index, frankly, if you have 20, 30 years, buy it every month and do nothing else, and you probably do pretty well if history's any guide. So that's fine to do. There's no reason to do anymore. The reason I started talking is because people were trying to do more, trying to get rich off these investments. And then a lot of people were just going way off the rails. And I just started writing like, hey guys, look, this doesn't work. To me, from my experience, it was pretty obvious, but it wasn't to people who didn't have that experience. And so that's how I think about it. Is that helpful? So I would just ignore the politics. I mean, come on, it's like so annoying to listen. I don't care which side you're on. It's just annoying to listen to anything. It seems like such a waste. They just know how to trigger you, right? Get you pissed off. Eric, who's in my group, says investing long term. I don't know if that's a question. Eric, you're there. I don't know if you want to clarify your question. But we're long-term investors in the group. Again, is it a value 1950, 1980, or 2010? Put it in there and what you're doing. Who else? There's so many people. Like, there's way more people who registered than are on the call. It's Christmas time. Things come up. I don't know. I think we'll just end it there. So, guys, thank you so much. I wish you all happy holidays, Merry Christmas, Happy Hanukkah, or whatever you celebrate. And it's a pleasure to talk to you. If you want to talk to me about Masters, we're just doing a last few people for this year. And we have some new features for next year and stuff. So thank you. Thank you so much. And on that note, we'll have some more Christmas music. See you guys. No, I'm not going to play guitar today. Go, Sebastian. All right, guys, we'll see you. Thank you. Enjoy the holidays.